Let me ask you something. Why is it that some people work for 40 years and still have financial problems, while others earn average salaries but manage to build wealth? It's not luck, guys. It's understanding basic financial concepts. In this video, I'm going to explain all the basic financial concepts that can assist you build wealth. So stay tuned as we get into it. So let's start with taxes. So taxes is the amount of money that you pay to the government. The government uses this money to fund services such as police, clinics, hospitals, those type of things. So there are different types of taxes that you pay to the government. Income tax. So income tax is the tax that you pay from your salary. Then you've got another tax called sales tax. Sales tax is a tax that you pay when you buy goods and services. So they add some sales. So let's just say you buy an iPhone, there's a sales tax added to it. Then you've got property tax. Property tax is the tax that you pay when you buy property, such as a house or a car. That is property tax. Then you got capital gains tax. So capital gains tax is the tax that you pay when your shares or investments increase in value. So the point that I'm trying to drive is that the salary that you earn is not yours. What is yours is what you earn after tax. That's the money that belongs to you. So now let's go into banks. Banks do two main things: they lend money and they store money. So let's check this. So when you store money, you earn an interest. The bank takes that money that you store and they lend it out to other people. They lend it out on an interest. So like I said earlier, when you store money, you earn an interest. But what you need to realize is that banks make money when you borrow, because they charge a higher interest rate when they borrow out the money than when you store the money. They give you a lesser interest rate and then take your same money and lend it out on a higher interest rate. So you need to realize that banks make money by lending out money. So now let's go into interest. So interest is the amount that you charge when you borrow out money. There are two types of interest. There's simple interest and compound interest. So let's take, for example, if you borrow $1,000, you will pay more than $1,000 because of interest. So let's look at simple interest. So simple interest is the interest that you pay from the capital that you borrowed, while compound interest is the interest that you pay from the capital plus the previous interest. So this is how it works. When you borrow, compound interest works against you. When you lend, compound interest works for you. So you need to understand how this interest works. And compound interest is what makes you rich when you lend, and compound interest is what makes you stay in debt for long when you borrow. Now let's go into inflation. Inflation means things go up in value. Things go up in value over time. So what happens is something that used to cost $1 10 years ago might cost $1.30 today. So this basically means that if you save your money or just keep your money in your bank account, it loses value over time. That's why it's important to invest, so that your investment can grow at a greater rate than the inflation rate. So inflation eats up the value of your money that is sitting in the bank. So let's go into recession. A recession happens when the economy slows down. Businesses lose money, people lose their jobs, and that's what we call a recession. So what happens is these recessions are normal. They happen in cycles. So smart people plan for recessions. They do this by saving money, avoiding debt, and saving for investing for long term. That's how you prepare for recessions, and they happen all the time. So let's go to investments. So investment is putting money into a place where it grows over time. There are different types of investments: real estate, stocks, bonds, and businesses. So investments involves risk. So you need to make sure that when you do an investment, you research. Um, what's the difference between an investment and savings? So a savings protects your money, while your investment grows your money over time. But like I said earlier, investments involve risk, so you need to do thorough research before investing. Let's go into credit score. So a credit score is a number that determines how trustworthy you are when you borrow money. So a high credit score means you are very trustworthy in terms of borrowing money. So to get a good credit score, you need to pay your bills on time. What decreases a credit score is when you miss payments. So what are the advantages of having a high credit score? A high credit score gives you better financial opportunities, easier for the banks to approve your loans, and you get good interest rates. So your financial reputation matters. So make sure that your credit score is in good condition. So guys, in conclusion, so if you understand all those concepts that I explained earlier, you already know more than most people. Financial education is not taught properly in school. So you need to make sure, if you enjoyed this video, please make sure that you like and subscribe, as I'll be dropping more financial videos in the future. Please make sure that you also click the notification button so that you get notified when I post videos. Thanks guys.